The IRS has been quietly making changes for 2026, and most retirees have absolutely no idea what's coming for them. And I know what you're thinking right now. I already filed my taxes. I'm fine. That's exactly what Margaret Collins thought too. She's 68 years old, retired nurse from Texas, 35 years of service, owned her home free and clear, had her Social Security all set up. She did everything right. She was careful her entire life. Then one afternoon, she opened her mailbox and pulled out an IRS notice. $11,400 owed. Not because she cheated the system, not because she missed some complicated form, simply because nobody ever sat her down and told her that selling the home she lived in for 22 years would trigger a tax trap she never even knew existed. That money came straight out of her retirement savings. Just gone. And here's what makes this really personal. Margaret is not some edge case. She is not an outlier. Thousands of retirees across this country are walking into these exact same traps right now in 2026, and the two biggest ones involve something you receive every single month and something you probably already own, your Social Security check and your home. So, in the next few minutes, I'm going to walk you through exactly what these traps are, how to spot them before they hit you, and what you can legally do today to protect your money. Because the IRS is absolutely not going to call you and warn you. That is what this video is for. Before we get into it, let me tell you exactly what we're covering so you can follow along the whole way through. We're going to talk about the Social Security taxation trap, the income thresholds the IRS uses to decide how much of your monthly benefit actually gets taxed, and why those numbers are silently destroying retirement income in 2026. Then we're going to get into the home sale trap, the capital gains exclusion rules, what changed, and the specific situations where retirees are getting completely blindsided. And then I'm going to show you the legal strategies that tax professionals are actively using right now to help their clients keep more money in their own pockets. Now, I want to be honest with you about something before we go further. I'm not here to scare you. I'm here to make sure you have the information your accountant might not even be bringing up in conversation. Because a lot of these traps only surface when you know the right questions to ask in the first place. So whether you're already retired or you're planning to retire in the next few years, everything in this video is directly relevant to your financial life. And the earlier you understand it, the more options you actually have to do something about it. Here's something that surprises almost every retiree the first time they hear it. Your Social Security benefit is not automatically tax-free. It never was. But the way the IRS calculates how much of it gets taxed is something that has been quietly punishing middle-income retirees for decades. And in 2026, it is hitting harder than it ever has before. Here is how it works. The IRS uses something called combined income to determine your Social Security tax exposure. Combined income is your adjusted gross income, plus any non-taxable interest you earned, plus half of your annual Social Security benefit, all added together. That single number is what the IRS looks at when they decide how much of your benefit to tax. If you are a single filer, and that combined number goes above $25,000, up to 50% of your Social Security benefit becomes taxable income. If it crosses above $34,000, that jumps all the way up to 85% of your benefit being taxable. And if you are married filing jointly, those thresholds sit at $32,000 and $44,000. Now here's where it gets genuinely frustrating. Those thresholds were set back in 1983 and 1993. They have never once been adjusted for inflation, not a single time in over 40 years. So a retiree living on a very modest fixed income today is being measured against numbers that were designed for a completely different economic era. The cost of living has gone up dramatically. Social Security benefits have increased over the years through cost of living adjustments, but the tax thresholds stayed exactly where they were 4 decades ago. What that means in real terms is this. Back in 1983, only about 10% of Social Security recipients paid any federal tax on their benefits at all. Today, that number is closer to 56%. More than half of all Social Security recipients are paying federal income tax on their monthly check, and the majority of them have no real idea why their refund keeps shrinking every year, or why they keep ending up owing the IRS money at tax time. And in 2026, this is getting worse because of one specific development. The IRS updated its provisional income calculation guidelines, which means certain types of retirement account withdrawals, including some Roth conversions that were done in prior years, are now being counted differently in the combined income calculation for certain filers. If you did any Roth conversion work between 2022 and 2024, you need to have a direct conversation with your tax professional about how that is being treated this filing year, because it may be pushing your combined income above a threshold you were not expecting to cross. There's also a behavior pattern that makes this trap much worse for a lot of people. They take one larger IRA withdrawal in a single year, maybe for a home repair, a medical expense, helping out an adult child. That one big withdrawal spikes their combined income, which then makes a much larger portion of their Social Security taxable for that entire year. One financial decision creates a chain reaction they never saw coming and never planned for. The way to manage this is through what tax professionals call income smoothing. Rather than taking one large distribution, you strategically spread withdrawals across multiple years in a way that keeps your combined income below or within the more favorable tax thresholds. A good CPA or financial planner can model this out for your specific situation, and the savings over a 10 to 15-year retirement can be genuinely significant. Now the second trap, the home sale trap, this one catches people off guard more than almost anything else in retirement tax planning, and the reason is completely understandable. Most retirees have owned their home for 20, 25, sometimes 30 or more years. And in most parts of this country, home values have gone up dramatically during that time. That feels like a good thing. And it is, until you sell. Here's the rule most people know about. If you are single and you sell your primary residence, you can exclude up to $250,000 of capital gains from your taxable income. If you are married filing jointly, that exclusion goes up to $500,000. To qualify, you generally need to have owned the home and lived in it as your primary residence for at least 2 of the last 5 years before the sale. That sounds pretty generous, and for a long time it was enough to cover most sellers comfortably. But here is what is happening in 2026 that is catching people completely off guard. Home values in markets across the country have appreciated so dramatically over the past decade that even with the full exclusion applied, retirees are still walking away from the closing table with taxable gains they never planned for and never budgeted for. Here's a real example so you can see exactly how this plays out. You bought your home in 1998 for $180,000. Over the years, you put in a kitchen renovation, a new roof, finished the basement. You're married, and you sell your home today for $890,000. Your total gain is $710,000. You apply the full $500,000 married exclusion. You are still left with $210,000 of taxable capital gains sitting right there. At a 15% long-term capital gains rate, that is $3,100 in federal taxes alone. And depending on which state you live in, there may be state-level capital gains tax stacked right on top of that. But here's the part that really blindsides people and almost nobody talks about until it happens to them. That $210,000 of capital gain does not just create a capital gains tax bill on its own. It also gets added to your total income for that year, which can push your combined income up dramatically, which then makes a larger portion of your Social Security benefit taxable for that same year, and which can also trigger something called IRMA, the Medicare Premium Income Surcharge. So one home sale can create a 3-way tax hit, all in the same calendar year. Capital gains tax, more Social Security taxation, and higher Medicare premiums. That is the collision that is catching retirees the hardest right now. There's also something called the partial exclusion rule that almost nobody knows about or uses. If you do not fully meet the 2 out of 5 years requirement because of a health issue, because you needed to move closer to family, because of certain unforeseen circumstances, you may still qualify for a partial exclusion. A lot of retirees who downsize after a health event assume they do not qualify at all and just accept the full tax hit, when in reality they might be entitled to a partial exclusion worth tens of thousands of dollars. That is money left on the table simply because nobody told them to ask. And then there is the cost basis question, which is honestly one of the most overlooked opportunities in this entire conversation. Your taxable gain is calculated based on your cost basis, what you originally paid for the home, plus the cost of qualifying improvements you made over the years. A kitchen remodel, a new roof, an addition, a finished basement, new windows, all of those can be added to your cost basis if you have the documentation. Every dollar you can add to your basis is a dollar that reduces your taxable gain. For homeowners who have been in their home for 20 or 30 years and who have made improvements along the way, reconstructing that basis properly before the sale can reduce their taxable gain by $30,000, $50,000, sometimes significantly more. Now here's where things become the most serious, and this is the situation that is hitting the most retirees hardest in 2026, selling your home in the exact same year you start collecting Social Security. That combination is one of the most financially consequential things a retiree can do, and most people do not realize how hard it hits until they are sitting across from their accountant and the damage is already done. The home sale drives your income way up for that year. That pushes your combined income above thresholds you were previously safely under, which makes 85% of your Social Security benefit taxable for that year, which simultaneously triggers the ERMAA Medicare surcharge, which can add hundreds of dollars per month to your Medicare Part B and Part D premiums. And because IRMA is calculated based on your income from 2 years prior, you could end up paying those higher Medicare premiums for the next 1 to 2 years as a direct result of one single year's income spike. All of that from one decision, selling the house where you raised your family and built your life. The solution here is timing and sequencing, and it requires looking at these decisions together rather than in isolation. If you have any flexibility on when you sell, coordinate that decision with when you plan to start Social Security, when you take out IRA distributions, and what your overall income picture looks like in each year. Sometimes pushing a home sale back by even 6 months, simply crossing into a new tax year, can dramatically reduce the damage. Sometimes it makes more financial sense to delay starting Social Security by 1 year to give yourself a lower combined income base in the year of the sale. These decisions interact with each other in ways that matter enormously, and planning them together is where you find the real money. Now, everything described so far is the problem side of this conversation. Here's what you can actually do about it, and everything here is completely legal, well-established tax strategy, and the kind of planning that people working with good advisors are already doing right now. The first strategy is Roth conversion planning. If you are in a lower income year, maybe the early part of retirement before Social Security starts, or simply a year where your income happens to be on the lower side, converting a portion of your traditional IRA to a Roth IRA at a lower tax rate now can reduce your future required minimum distributions, which reduces your future combined income, which reduces how much of your Social Security gets taxed going forward. The math on this over a 15 to 20-year retirement is very compelling for a large number of retirees, and it is worth having someone model it out for your specific numbers. The second strategy is qualified charitable distributions. If you are 70 and a half or older and you give to charity at all, you can donate directly from your IRA to a qualified charity, up to $105,000 per year in 2026. And that distribution counts toward your required minimum distribution for the year, but does not show up in your adjusted gross income. That means it does not affect your combined income calculation. It does not push more of your Social Security benefit into taxable territory. It is one of the most underused strategies in retirement tax planning, and most people have simply never heard of it. The third strategy is documenting your home improvement costs thoroughly before you sell. Go back through your records right now. Bank statements, old contractor invoices, building permits, receipts from the hardware store for major projects. Every dollar you can legitimately add to your cost basis is a dollar that directly reduces your taxable gain. This exercise alone, done carefully and with good documentation, can be worth an enormous amount of money for long-term homeowners. The fourth strategy is doing a retirement tax projection every single year. Not just at tax filing time, not just when something major happens, but annually and proactively. Have someone model out what your income looks like this year, next year, and the year after, and identify whether you are approaching any of these thresholds before you get there. Because the difference between landing just above a threshold and just below it can be thousands of dollars, and in many cases, you have real tools available to manage that, but only if you see it coming with enough time to act. Here is your clear action plan, because information without action does not protect your money at all. The first thing you should do this week is calculate your combined income number. Take your adjusted gross income, add any non-taxable interest, add half of your annual Social Security benefit. That single number tells you exactly where you stand relative to the taxation thresholds right now. If you are within $5,000 to $10,000 of crossing from the 50% zone into the 85% zone, that is a serious red flag that needs a planning conversation immediately. The second thing is to pull your home cost basis documentation together before you do anything else related to a potential sale. If you are thinking about selling in the next 1 to 3 years, start gathering your original purchase documents, your renovation receipts, your improvement records now. Give yourself time to do this properly and completely rather than scrambling in the weeks before closing when it is much harder and much more stressful. The third thing is to get a real proactive planning conversation on your calendar with a CPA or financial advisor if you have not had one recently. There is a meaningful difference between someone who files your taxes and someone who does retirement tax planning. Filing looks backward at what already happened. Planning looks forward at what you can still control. You genuinely need both working together. Here is what I want you to take away from everything covered in this video today. The IRS is not going to send you a friendly warning letter before any of these traps hit you. They are going to send you a bill after the fact. And by that point, your options are significantly more limited than they would have been with even a little advanced planning. The retirees who are protecting their money in 2026 are the ones who understand how these pieces connect, who are asking the right questions before they make major financial decisions, and who are planning ahead rather than reacting after the damage is done. Margaret Collins, the teacher from Ohio, she eventually worked with a tax professional to set up a payment plan and restructure her future distributions. She got things under control. But she will be the first person to tell you she wishes someone had explained all of this to her 3 years before she ever sold that house. You still have time. That is the entire point of this video. If this helped you understand something you did not know before, please hit that like button right now, because it genuinely helps more retirees find this information when they need it most. Subscribe to this channel because every single week there is new content specifically about protecting your retirement income, reducing your tax exposure legally, and making sure you keep the money you worked your entire life to earn and save. And if you have a specific question about your own situation, drop it in the comments below. Every comment gets read, and the goal is always to point you in the right direction. The next video is going all in on Medicare IRS, exactly how that surcharge gets calculated when it kicks in, and the specific strategies people are using right now to avoid it. That video is going to save you real money too, so make sure you are subscribed so you do not miss it when it goes live. Thanks for watching. Go take care of your retirement.